Welcome back. In this session I will talk about maybe the most well-known approach to assess migration risk, called credit metrics. I'm quite sure you came across this in other courses before. I won't go into all the details. It might be maybe even a nice topic for a group presentation to explore this a bit further. I just want to highlight a few points I want to make and a few issues with this framework. I think in particular going forward that big data and machine learning tools will replace some of these models because they do rely on sometimes quite strong assumptions, which I will try to highlight briefly. Now, I think that the main challenges are that whenever we try to understand risk in the sense of migration risk, or put differently, default risk, it's very difficult to assume that anything we derive is remotely normally distributed, because we tend to focus a lot more on the downside risks. This is simply driven by our payout profile. The other aspect is that in the case of fixed income securities, the link to market risk is not really that straightforward. Yes, if you think about the equity market, well, we can use the capital asset pricing model, which we also know is not really perfect, and there are of course issues with measurement of the market portfolio, and there are problems in how it can be applied, say, in emerging markets. But it's still a lot more valid, I would argue, to link stock returns to market risk. Now, the same is not as straightforward in the context of fixed income securities. But of course, market factors matter. And we already touched on this before. We know, for instance, that macroeconomic conditions certainly matter, but also other factors. Now, credit metrics looks at this migration risk from a certain perspective, and it's very much driven by ratings and believing in ratings and transition between ratings. Now, there are pros and cons with it. It is used a lot, one has to be honest, but of course one limitation is maybe too much focus on ratings and the transition risk in this particular case. So how do we go into this? So I think this is maybe a helpful overview. So there are different components to the model. I won't be able to cover everything in a lot of detail, but the first element here in the center is the BB1 element, and we will talk about this in a bit more detail. And this is mostly around issues of transition probabilities, and we look into this in a minute when we talk about correlations. There again you make a few strong assumptions, which again are very similar to alternative methods like the Merton approach as well. And then the issue around exposure, and we also remember the initial equation we had about exposure, how we could think about this. Now let me just look into the so-called transition matrix. Now this is actually quite interesting. Now what this approach does is it looks at historical data and simply explores whether a AAA rated security remains AAA rated within a year. And it does this for all the different ratings. And what you can observe is that there is a good degree, I would say you might call this a stickiness, that if you are highly rated, you most likely will remain highly rated. If you go down below to lower levels of ratings, you see more of a transition happening, in particular when you come then to the junk bond categories. Yeah, so here the transition probability is an awful lot higher. Now, looking at this, we could read this as follows. So, for instance, the transition from a AAA going down to a AA, it has a 8.3% probability. Yeah. And a further downgrade is a lot less likely. So what you see immediately looking at this is that if there is a rating change within 1 year time frame, it's most likely a change by one category. Yeah, so in particular, if you go into the higher rated ones, this is what you would expect. And also the uptick and the downtick is also interesting to observe. Yes, if you are AA rated, for instance, it's quite possible you go down to A, 7.79%. It's not as likely you go up to a AAA. Yes, you can basically look at these probabilities between different categories. Now, this is definitely helpful to understand up and downside risks. So, for instance, if you look at the BBBs have quite a bit of upside potential, yeah, compared to downside. So sometimes also from an investor perspective, you might select different types of ratings because you hope there is an upside to it, and you hope you can manage the downside. Now, the main issue with that is that all of these transition probabilities depend on historical data. Yeah. So end of the day, this is all we do. We look at historical data and we calculate these transition probabilities. Now, the thing is, if you want to do this for forecasting, you assume implicitly that your environment remains constant. Now, we already know, and there's this KMV approach, that the macroeconomic environment certainly matters. Yeah, so this assumption is quite of limited use, shall we say. Then what you also do is you then can calculate default risk for different time periods, for different rating categories. And of course, there's an obvious relationship between the rating and default risk, and you see that in particular when you go down to the chunk level, the default risk is absolutely astonishing, to say the least, but it also seems to stabilize. So once you are beyond 5 years, it seems to anyway stabilize. But of course, again, this is done on historical data, and the issue with default prediction, and I have worked on this quite a bit, is that default risk is not very high. So I have done a study on the UK, looking at all registered companies in the UK, so more than 7 million companies, and usually default risk is depending of course on the time frame, is in the region of less than 1%. Yes, it's not very common. Yeah, and there are not many cases where a AAA rated security goes bust, for instance. Yeah, so that's not very likely. And so you are in an area which you call a rare event problem. And there is the so-called rare event bias. There is a tendency that you understate rare events. So this, of course, limits the use of these methods. One has to be a little bit skeptical. Yeah, so that's fundamentally what BB1 is doing. It looks at these credit risk horizons. The focus is usually 1 year, and then also the other element is it looks into forward pricing models. So that is all about the term structure and how the term structure, of course, influence bond prices. We will cover this in a special session because that is not at all trivial, and we will do some modeling using Python to actually get our head around that. So the main issue and the limitation of this approach is definitely the assumption that the transition matrix remains the same over time, which of course is something you can definitely doubt. Then what is also used here, and this comes in BB2, so if we go back to our overview, BB2 is now focused down below on the portfolio value at risk. So that's this element, and that is bringing in Monte Carlo simulations. Now, Monte Carlo simulations are always sounding very fancy, but again, you have to be very careful what you assume in these simulations. So these simulations tend to still assume, for instance, joint normal distributions of asset returns. Now, it's again, of course, it's an assumption. Asset returns, which are quite often not observed directly, they tend to be then derived from equity returns in this approach. Now, are they normally distributed? The answer is not really. Not really. You tend to have fat tails in these distributions, which means it's much more likely that you have very negative values and very large positive values. That of course matters in particular if your downside risk is the one you want to focus on, because then actually the extreme events might be much more interesting and much more important to explore. So that's a limitation. But again, there is no straightforward way to address that. And then there are additional assumptions you make. I don't want to go into the technicalities like the Koletsky decomposition, where you also make certain assumption about movements of variables, which variable moves first. So this is also linked to so-called structural vector autoregressions, and of course there are issues with it that limit the ability of this model to actually forecast risk. Now, I will just show you the outcome. I don't want to go into this notation because I don't think it's massively helpful. So basically what you do then is you run these Monte Carlo simulations, and you can of course assess a value at risk. But of course, have in mind it's not a magic bullet, because it's always based on certain assumptions for your simulation. We will run some simulations in our block taught element, and we will see, of course, they can be insightful, but they can also equally be quite misleading, because they are of course heavily driven by what you put into them in terms of assumptions. Now, another element which of course is problematic is the use of equity returns in understanding asset return correlations. So that's a standard thing, but again, this is very common because you don't usually observe the assets directly, because most of these assets tend to be very illiquid, are highly specialized, and not really traded as well. So it's very hard to understand it. So the best proxy quite often is indeed to look at equity returns, but equity returns have usually a much higher level of volatility. So that's of course a limitation of these models. Then what you see a lot, and I won't go into the details except you want me to, is methodologies to reduce the dimension of the problem, because end of the day you have very large portfolios, you have many different loans, hundreds, thousands of them, so you end up with a huge matrix for which you would derive basically a covariance matrix first. And this can be reduced using what is called a principal component analysis. And there are different types of it that could be applied. It's called dimensionality reduction. There is also a whole section in the area of machine learning that deals with this problem and develops methods to reduce the dimension of a problem without losing too much information. So intuitively, the idea is you start with a very large set of variables, say 1000, and you have a huge covariance matrix, 1000 times 1000 matrix, and then you apply principal component analysis to break this down into a few principal components. And this is done using an eigenvector decomposition. If you want me to, I can show you the mathematics behind it and how this is done in Python. And this again is an important element of analysis in machine learning. It's used a lot. It's in particular also used a lot in marketing, in various areas. So that is a very common tool. But of course, whatever you do in this case, it depends on how this reduction is done, how much information do you lose, and the information loss could be important, in particular if you deal with rare events. And here we do deal with rare events. So I have done similar things also for modeling default risk, and there are problems with it sometimes. So one has to look into this more carefully. Then the final element here is exposure. Now, exposure depends on a whole host of factors, and again, it can be modeled using, of course, certain assumptions you make. And I think I just have an example here. This is for an interest rate swap, where exposure could occur during the lifetime of the swap. It depends, of course, whether the swap is in the money, out of the money. That determines exposure in this particular case. Now, of course, again, what you do here, once in particular you go into options, is you do make, of course, assumptions about volatility, which is the main driver for it, which of course has again its limitations. Yeah, so we already covered parts of the options approach to measure default risk, because here again there is a tendency that you focus on what you see on the equity market as a proxy of volatility. Volatility is the main driver for option prices. But again, of course, there is a limitation. So end of the day, many of these approaches do depend on historical data, and there is always a limitation to that. Again, there are ways to overcome this, splitting historical data into training and test data, and try to predict what we already know, so to speak, and we can also explore that further. The structural models are then used in this context. Again, I worked on this quite extensively, but of course there are limitations as well, which of course we already discussed before, and again is linked to the difficulty to observe the asset values. That's the main trouble. Good, I'll stop here.